Hi everyone, I'm Dr. Steph. It's the start of a new year, and that means additional contribution room is being added to the TFSA. So today I'm going to do a deep dive into this account and why it is the most powerful tax shelter that is legal and accessible to everyone, not just the super wealthy. But this account does come with a lot of rules, and if you don't follow these rules, it can actually be costly to you. So in this video, let's go over the 10 things you need to know about the TFSA. If you have a question, leave me a comment, and if you find the lecture helpful, feel free to like and subscribe to be notified of future lectures. Rule number 1, the TFSA is not like the savings account that you get at the bank. While the TFSA stands for the tax-free savings account, it is misleading. It is not actually a savings account, nor should you use it like one either. It is better used as an investing account. A huge mistake beginners make is they open a TFSA, they put money into it thinking it'll collect interest like a savings account at the bank. To their surprise, they look at their deposit after a year and there's no change to the number. So a TFSA is basically like a pot that you can obtain at a bank or online brokerage. Money is like the dirt that you put into the pot. If you just put dirt into the pot, nothing will grow. So you have to purchase different investments within the pot, and these are the seeds that will grow. So, number 2, anyone can open a TFSA as long as you're a resident of Canada, 18 years old, and have a valid SIN. If you move and you're a non-resident, but you're 18 years old, you can still open a TFSA, but whatever investments you have in there remain tax-free. But any additional contributions made to it while a non-resident will be subject to a 1% tax every month. So that's quite a lot, and be careful about that. Using the TFSA as a savings account doesn't maximize its full potential. So I said earlier that the TFSA as an investment account optimizes its full potential. In the past, people would think about using their TFSA as a place to save up for their first home. So they might invest in fairly safe but low gain investments. So they would open up a savings account in there, paying less than 2% interest in their TFSA pot. This isn't a great idea for 2 reasons. So first, there is the FHSA, or the First Home Savings Account, which is an even better account for you to park your money into safer assets for your down payment. And you can also use your RRSP home buyers plan, both of which I talk about in this video, which I'll link up there and down below. Second, the TFSA is a tax shelter. So if you put your money into something, let's say that only gains 2%, so you don't pay tax on the 2% gain or on that $81,000. But if you purchase an investment that gains 6%, you will save tax on that 6% gain, so on that $474,000. It is much better to not pay tax on 6% than on 2%. Now, this is an overly simplified example that doesn't take into account additional money that you put in over the years, but it illustrates why the TFSA should be used as an investing account. Rule number 4, the TFSA has strict contribution limits, and knowing the contribution limits are important, especially if you immigrated to Canada recently. This year, in 2024, we are getting $7,000 of extra contribution room, which is indexed to inflation and rounded to the nearest $500. So if we have a high inflation year, then the TFSA room will be greater, but it will never go below $5,000, which is the base amount. How much you can contribute to your TFSA depends on when you turned 18. So if you turned 18 2009 or earlier, you would have $95,000 of contribution room in 2024. If you immigrated to Canada after you turned 18, how much contribution room you have depends on when you became a Canadian resident and got your SIN, not based on when you turned 18. So if you immigrated in 2014, even though you turned 18 earlier than 2009, you will have a maximum of $69,500 of contribution room in 2024. So rule number 5, the tax shelter room has limitless upsides, but also significant downsides. So I just said earlier that there are contribution limits, but there is no limit to the growth of your assets inside the TFSA. And that can potentially grow your tax shelter room to even higher than the contribution room limits. Let me explain with an example. Let's say you max the contribution limit of $88,000 in January 1st, 2023, and grew it over the year to $100,000. In December 31st, 2023, when you withdraw the money, how much can you contribute in January 1st, 2024? It would be $100,000 plus the $7,000 of the annual contribution room that you would get. On the opposite side, if you invested your $88,000 into something risky and the price drops to $10,000, if you sell and you withdraw that money in December 31st of 2023, then in January 1st of 2024, you would only have the $10,000 of that room you withdrew and the $7,000 of your annual contribution room. While your TFSA will never go into the negative, when you lose the room, you can never get it back. So remember, buying and selling investments in a TFSA doesn't make you gain or lose space. It's only when you withdraw. And why is December the best time to withdraw compared to other months? This is because withdrawals made from your TFSA in the year will only be added back to your TFSA contribution room at the beginning of the next year. So if you withdraw from a TFSA in December, you only have to wait 1 month before you could put the money back into the TFSA in January. If you withdraw in January, then you have to wait a whole year before you can put money back in, missing out on a year of potential investment growth. The exception is if you still have room left and what you put back into the TFSA doesn't exceed your contribution room, then you can put your money back in. Now, kind of related to this is rule number 6 is you can't day trade in a TFSA. So in 2011, an investment advisor named Fareed Ahmed day traded penny stocks in his TFSA and grew $15,000 of contribution room into $600,000. He ended up paying tax on his investment because the CRA considered the day trading activity to be active business activity and it's considered taxable. The CRA doesn't exactly say how long you have to hold the securities before selling them to be considered day trading, but they have set aside some rules that I've listed on the screen. Generally, my accountant told me that if I hold the security for at least a month and then if I sell it, and maybe if I buy it again, then I'm safe from this rule. However, I'm curious what you've been told by your accountants, so let me know in the comments. So number 7, it's important to know what you can invest inside the TFSA. So things like cash, mutual funds, stock and ETFs, bonds and GICs, as well as certain shares of small business corporations. However, you can't invest in cryptocurrency or properties in your TFSA. The exceptions are REITs or real estate investment trusts and crypto ETFs are allowed. Even though these are the options for investing in a TFSA, it doesn't necessarily mean that it's the right investment for you, and that's when speaking with a financial planner might be helpful in identifying your goals in using the TFSA. So what should you invest in a TFSA to optimize its use? Well, first of all, if you have risky investments that can go down significantly, those are better to be in an unregistered account to prevent loss of contribution room. If you have US dollar stocks or ETFs, they will be charged a 15% withholding tax on the dividends of those stocks, but not the capital gains. So it is better to hold those in the RRSP where the tax won't be charged. Now, 15% of the dividends only is might be a very small amount, right? So I wouldn't let the tax tail wag the dog. Now, ideally, you want TFSA investments to grow while being stable at the same time. So if this is something you plan to hold for a long time, you can consider a well-diversified ETF or an all-in-one ETF, which is discussed in this video, which I'll link up there and down below. And there are many options to choose from. The only other thing to note is that if you want to invest in REITs, the one benefit of using the TFSA to invest in REITs is that REIT distributions are taxed at your marginal tax rate, which can be higher than how dividends or capital gains are taxed. So if REITs are something you're looking into, putting them into the TFSA can shield the distributions from tax. Rule number 8. You can open multiple TFSA accounts at different banks and brokerages, but the total amount can't exceed your contribution limit. If you do decide to open multiple TFSAs, it's especially important you don't end up over-contributing. If you open a TFSA and you decide you want to transfer the funds from one TFSA at a bank to another TFSA with a different bank or brokerage, you can initiate a transfer in kind instead of doing a withdrawal. Now, overcontribution will have a 1% per month penalty on the excess amount. Unlike the RRSP, where you have a $2,000 overcontribution buffer, the TFSA does not. You really don't want to overcontribute because being charged 1% a month or 12% a year will eliminate any returns that you have. So if you overcontribute, withdraw the amount as soon as you find out. And I recommend that you keep track of any time you contribute or withdraw on a spreadsheet. You can also see how much contribution you have on the My CRA account, but this information is not up to date. The CRA only knows how much room you have after you filed your taxes. So if you contributed but haven't filed yet, your CRA account won't reflect the most available contribution room. Finally, designate spouses as a successor instead of beneficiary because this is a way to grow your contribution room even more. If the original owner of the TFSA dies, the spouse or common law partner who is named as the successor owner will become the new holder of the TFSA immediately upon the death of the original owner, and income earned before the estate is settled will also not be taxed. Also, the successor won't have their TFSA room affected by becoming the holder of the deceased person's TFSA and can consolidate both accounts together instead of managing two separate TFSA accounts. This is called a qualifying transfer. So for example, if my husband had $100,000 in his TFSA and I have $80,000 in my TFSA, if he passes away and I am the successor, I will now have $180,000 of TFSA room. And between the time he passes away and the estate settles, and let's say his TFSA assets grow another $1,000, that also can go to me tax-free. Now, successors can only be spouses and common law partners. Beneficiaries can be anyone like children, siblings, or friends. A beneficiary is different because when the TFSA owner dies, the beneficiary only gets the assets from the TFSA, but not the account itself. So for example, if my mom had $100,000 in her TFSA and I'm the beneficiary and I have $80,000, if she passes, then the $100,000 will get passed to me tax-free. But any growth of that $100,000 between the time of death and when the estate is settled will get taxed unless I have extra room in my TFSA to account for it. So that brings me to the end of the 10 things you need to know about the TFSA, and I've listed them all on the screen. If there are any questions, feel free to leave a comment down below and support the video with a like and subscribe. Thank you for watching.